We're going to be talking today about the investment process at Every's Investment Managers to get a sense of how it operates and the results it produces. So Tom, a good year in 2013 after a great 2012 in terms of client portfolio outcomes. What do you do differently from other groups?
Well, the biggest difference we have in our process is where we focus on a dynamic approach to asset allocation. And what do I mean by that? Essentially, we don't find ourselves hidebound by 30 to 40-year long-term models which have got random economic facts fed in, looking for long-term relationships with different asset types and economies, often that don't have much validity for the short term. Take, for example, the fact that 20 years ago, the UK government bond was yielding 9%. Inflation was in excess of 10%. Now the gilt yield is 2.5%. Inflation is a little more than 2%. It's very hard to make sense of those long-term valuation measures in terms of what is happening in current markets today.
Okay, so that's clear. But presumably, macroeconomic forecasts inform your asset allocation to some degree.
You're absolutely right. However, for us, what's more important is the direction of economic travel rather than the absolute level of economic growth. The best example I can think of is what happened in the US economy last year. A number of investors voted heavily towards growth in late 2012, 2013. We saw markets rise by 25 to 30%, a long time before any economic forecaster changed his numbers. So what's different for us is that we're valuation oriented rather than sticking to a particular GDP target. And in terms of that, what really matters for us is how much things are worth. And we spend a lot of time working out how much things are worth and how much do we have to pay for them. A further example, perhaps, is what's happened here in the UK. The UK economy was seen to be double dipping and treble dipping and not a good place to invest. We saw things differently and saw a great opportunity in small to mid-cap stocks in the UK. We loaded up weightings 18 months ago and have been rewarded significantly in this area. If we'd followed the economic forecasters, we would only now be looking at this area as a place worthy of investments.
Thanks for that, Tom. Now turning to stock selection, how does your process differ from others and the type of investments that you pick?
We do, of course, invest in direct equities like many other managers, where we see there being a number of major anomalies. However, our point of difference is really focusing on being a gateway to a range of excellent fund managers, and we do this through the medium of investment trusts. Many other discretionary managers do not follow this route for all sorts of reasons, but investment trusts, often seen as the investment industry's best kept secret, is an area that we're very, very happy to operate in. With investment trusts, we have the scope to benefit from positive gearing at the right time, from enhanced income, and from very strong performance, where investment trusts typically outperform their open-ended peers. So we focus on genuine stock picking, contrarian styles. We're looking for managers who will be unconstrained in their benchmarks, and the result of this typically is strong outperformance.
So once set up in the right style, in line with risk-adjusted client objectives, does the performance look after itself?
Unfortunately, Linda, it doesn't. We're not able to employ the fit and forget approach, which means just plug the investment in and hope that in 12 months' time it's done what you want it to do. Our portfolios benefit from continuous oversight. We meet with the managers we invest in, whether that's here in Exeter, in London, or indeed coming to our offices in Honiton. We try to understand their style and their philosophy and get close to what they're trying to do in terms of investment objectives. If we start to see any inconsistency in that, and if the profile changes in a way that we're not happy with, we will ask questions. If those issues aren't resolved, we will sell out of the portfolio pretty swiftly. One of the things we're also looking for, though, are new managers that are coming through, rising stars who have a different perspective and a different approach. And in the last year or so, that's been very positive for our performance, with 2 or 3 young stars coming through. And finally, when it comes to keeping an eye on these things, being small and nimble in terms of our approach to investment investments does help. The investment trust sector is not always the easiest to invest in, and a lot of the larger groups have discounted it as part of their investment strategy. Thankfully, that's the benefit of performance at Everys and the performance that our client portfolios are able to benefit from.
Thank you, Tom. Some very useful insights. We look forward to catching up with you again very soon.